U.S. banks step up lobbying against stablecoin. Yield as Senate moves, U.S. bankers are intensifying their lobbying against yield-bearing stablecoins as the Senate moves closer to action on the rules that govern them, according to a June 20th report from Cointelegraph. The pressure campaign reframes a debate that had mostly run through regulators into a direct fight over where Americans keep their dollars. The core dispute is narrow and old. Banks fund lending by holding customer deposits, and deposits are cheapest when they sit in accounts that pay little or no interest. A stablecoin that pays a return on the same dollars threatens that model. If a token pegged to the dollar pays a yield, and a standard checking account pays close to nothing, money has a reason to move. The deposit math behind the pressure. A bank's profit on a deposit comes from the gap between what it pays the customer and what it earns lending that money out. Low-cost or zero-cost deposits widen that gap. Yield-bearing stablecoins compress it by giving holders an alternative that pays them to wait. That is why the lobbying has sharpened now, rather than a year ago. The Genius Act framework that Congress advanced for payment stablecoins left the yield question contested, and several related measures have kept the issue live. SpendNode has tracked the run of activity, from a state-level stablecoin statute in Delaware to Federal Reserve work on KYC rules for issuers. Each step narrows the open spaces, and yield is one of the last big ones. Banks argue that letting stablecoins pay interest would pull deposits out of the regulated banking system and into instruments that sit outside deposit insurance. Crypto firms counter that paying holders for their own dollars is a feature, not a loophole, and that blocking it protects incumbent margins more than consumers. Both readings can be true at once, which is part of why the fight is hard to settle. Stablecoins are no longer a side market. The numbers are large enough that the outcome matters beyond crypto. Fidelity recently opened a money fund built to hold stablecoin reserves under the Genius Act, a sign that mainstream asset managers now treat reserve management as a real business line. When a reserve earns a return, the next question is who keeps it? The issuer, or the person holding the token. That single question is the one banks want answered in their favor. If issuers can pass reserve income to holders, a dollar stablecoin starts to look like a checking account that also pays. If they cannot, the income stays with the issuer or its partners, and the token behaves more like cash that happens to live on a blockchain. The Senate timing raises the stakes. Lawmakers have already been pressed on jurisdiction, including a push from senators asking Treasury to clarify state authority under the new rules. A yield decision layered on top of that would shape product design for years. The stakes for people who spend from stablecoins. For people who actually move money, the yield question is not abstract. A growing number of users fund cards directly from stablecoin balances rather than holding fiat in a bank, because a USDC or USDT balance can sit ready to spend without a conversion step. If those balances also earn yield, the case for parking spend money in a token instead of a bank account gets stronger. A yield ban would not stop stablecoin spending, but it would flatten one of its advantages. The balance would still spend the same way through a card, yet it would no longer pay you to wait between purchases. Holders weighing where to keep a buffer would lose part of the reason to choose a token over a savings account. There is a counterpoint worth keeping in view. Yield is never free. A stablecoin paying a return is earning it somewhere, whether from short-term treasuries, lending markets, or other reserve strategies, and each of those carries its own risk. The collapse of custodial yield products in past cycles is a reminder that a quoted rate and a guaranteed rate are not the same thing. Readers comparing a yield-bearing balance against an insured bank deposit should price that gap, not just the headline percentage. Crypto markets were steady as the report landed. Bitcoin traded near $63,600, up 1.4% on the day, with Ether around 1,724 and the Fear and Greed Index at 21, in fear territory, as of June 20, 2026. The lobbying push is a policy story, not a price one, but it points at a structural question that will outlast any single session: whether a dollar on a blockchain is allowed to pay its holder.